Are you new at trading and having trouble understanding this? I shorted DPW because I saw exhaustion in the chart, saw a death candle, which showed me backside. And I totally ignored the fact that the stock already rotated its float several times. And then all of a sudden it teleported, squeezed me out, and I had to take a loss.
Okay.
Did any of that make sense? Don't worry if it didn't, because after this video, it will. Bears and bulls. You should know this, but if you don't, a bull is anyone who is long bias, and a bear is the opposite, a short bias trader. Longs and shorts. Longs are people who are buying the stock, buying low to sell high, and shorts are the opposite. They're the people who want to sell high and buy low. Squeeze means when you're in a short position, right? You think it's done for, but all of a sudden it builds back up, breaks a key level where shorts are wanting to cover, right? It's a key area of resistance that makes a short seller not comfortable. Therefore, they're gonna wanna cover to take their loss or take some profits because maybe it's shifting trend. And then that creates a squeeze where multiple shorts are doing this at once. And then you have the longs who are buying at that same area. And therefore we get a quick squeeze that goes straight up and the stock recovers quickly. Exhaustion. You see exhaustion when you see a stock maybe attempt to break high a day. It's trying to break high a day, and then when it does, it has tons of volume following that break, but then it doesn't go anywhere. And instead, it comes back down. The front side. Front side of a move is just that. It's the front side of a move. It's where you don't want to be if you're a short seller. It's where you want to be if you're a long bias trader. You can see it by drawing a trend line and also seeing higher lows and higher highs. That leads me to the opposite, backside. The backside of a trade is where you want to be if you're short and where you don't want to be if you're long. And the backside is the opposite. You want to see lower highs and lower lows. And you could draw a trend line showing that as well. Fake out breakouts. There's tons of fake out breakouts. That's when you buy a breakout and all of a sudden it just rejects, kind of like the exhaustion. It shows you some exhaustion and then rejects, comes back down, and therefore it's a fake out breakout. A volatile stock just means that it's very volatile, right? It means that it's going up, down, it's a ton of range, and it could be a lot of range for opportunity if you have very good risk management. But sometimes some people get burned very, very, very badly when it comes to volatile stocks because you don't have good risk management and you're gonna take bigger losses if you're not prepared. So volatile just means be careful, this stock can move. Float. You may hear this term a lot. You also hear outstanding shares. All you need to know is the float is the amount of shares that are going to be exchanged throughout the day that's available to the retail traders. Float rotation means when a stock rotates float, it means it goes through its entire float and then goes through it again and again and again. So if a stock has 3 million shares in the float and it's traded 6 million shares throughout the day, that means it's rotated its float twice. If it has 9 million shares throughout the day, that's 3 times. Float rotation can be dangerous when it comes to a new trader because there's a lot of volatility. A catalyst just means that there's some type of news that's pushing the stock, or it's a newsletter, or there's a pump, which just means a chat room that's buying that stock up, and it could also mean that it's a hot sector. Supernova and parabolic are kind of the same thing. It's when a stock all of a sudden gets a perfect black swan event, or maybe has a catalyst behind it like news, or maybe it's squeezing shorts like we talked about earlier, and it just goes from like $1 to $2 to $3 in a short period of time. Death candle is a sign that the stock is potentially dead. It's one long candle that is a red candle, and it's being a sell-off with massive volume following behind it. So remember that you gotta have volume behind the move for it to really be a death candle. The line in the sand is not
cross this line, I'm gonna take your ass out. It's not that. What it
is whenever you have a key area on the chart, maybe it's a support area that's never broken before, and it finally breaks. That's the line in the sand. When it breaks that line, everyone who bought above that line is now underwater. So the line in the sand usually shows that when it does break, we're gonna get followed through to the downside. Ascending triangle is a stock that has a horizontal line on top with higher lows coming up to it. That is an ascending triangle. A descending triangle is the exact opposite. It's lower highs with a horizontal line below it. Ascending and descending are just signals that potentially the stock can move and continue in the direction that it's headed. And in this case, an ascending triangle can go further up, a descending can go further down. A low flow is anything that is between 2 and 10 million shares. A micro flow is anything under 2 million shares. Typically, if you see a stock that is under 1 million shares, I highly suggest as a new trader, stay away because micro floats can ruin your account. A choppy chart just means that it's not smooth. If you can't really see a trend forming, if it's just erratic, then it's a choppy chart, and sometimes those aren't the best to trade. A teleported move is just that. It's when you see a stock that is at one price 1 minute, and then within the same minute or maybe a minute later, it just teleports. It jumps to a whole new price, maybe from $1 to $4 in a blink of an eye. That's what we mean when a stock teleports. A waterfall is similar to a death candle, and in most cases that I've seen, you'll usually have a death candle followed by the waterfall. And that just means a continuation of just completely red prints going down, and it's just being a sell-off. Slippage means whenever you want to get out of a stock at $1 and you put a limit order at $1, but it slips through that order and goes to 97 cents, you don't get executed. So sometimes you want to be aware of slippage and account for that with your risk management. Over under just means when a stock is over and under a certain key area. So if you have a key area, let's say the line in the sand that we talked about earlier is $1 and it's over under $1, meaning if it's, at $1.01, then at $1, then 99 cents, then at $1, then $1.01, that just means that it's over under. And whenever it picks a side, whether it's up or down, that's the direction that we should be able to count on for follow through. Support, just think of it as the floor. It's at a level, a horizontal line on the chart where it could not break through. In this case, example, as I used earlier, is a line in the sand at $1. If it can't break below $1, that is the floor, AKA the support. Now, support can also be drawn in a trend line fashion, as well as resistance. Now, resistance is the opposite. That's the ceiling. That's where a stock could not break above a certain price level. So if a stock was reaching to $1.50 and couldn't break above $1.50 and it's tried multiple times, that's what we call resistance, or you can also say a ceiling. Bag holders. You'll hear this term a lot, especially if you're trading small caps. Bag holders is every single person who bought this stock in the past at a higher price and just are holding and hoping that it's going to come back to that price. So they're just holding the bags of money that they're just burning away, and they're hoping that it's going to go back up to that price. Midday lull, that is the boring part of the day. A lot of traders typically stay away from midday because it's very choppy, what we talked about earlier, which means it's not as predictable. So midday lull is typically midday between lunchtime and right before 1 o'clock Eastern. Power hour is typically the last hour to last 2 hours of the day. We use the term power hour just as a term. It doesn't always mean the last hour. Sometimes it can be the last hour and a half, but typically it's between the last hour and the last 2 hours of the trading day. A pump and dump. This is exactly what it sounds like. It's someone pumping in stock. They're pumping it up through a chat room or through fake news, or trying to get it going higher because they want to dump their shares at the top where they're dumping them on you guys. So it's a pump. They pump the price higher because they bought low, and then they dump all their shares on you, and that's what we call a pump and dump. Chat pump and newsletter pump. That's the same idea as the pump and dump. So when you hear these terms, think of them as one. A sheep is anybody who follows a trade alert. Anyone who just buys something because someone says to buy it, sell it because someone else said to sell it. You don't want to be a sheep. You want to be your own trader. You want to be a leader, making your own decisions for your own trading account. Go back to the beginning of this video because now you will understand what I meant when I was talking about shorting DPW and getting squeezed out because of float rotation. If you're enjoying this content, be sure to like, subscribe, and hit the bell so you're notified for future content.